Hello, everyone, and welcome to today's edition of Interactive Brokers IBKR podcast. With me today is Ed Clissold. He is the chief U.S. strategist at Ned Davis Research, NDR. He and his team are responsible for the firm's U.S. equity, style, sector, and equity theme analysis. They do so via a combination of a top down analysis of the macroeconomic and fundamental environments and a bottom up analysis of factors specific to the asset class, market cap, style, sector, or theme. He and his team also provide in depth macro research on fundamental topics such as earnings, dividends, and cash flow. With me today, Ed Clissold. Welcome, Ed.
Oh, thanks for having me. Excited to be here.
Terrific, terrific. So, you're the US strategist. Where do you see the market going this year?
Yeah, we have a year-end target because that's what everybody asks for, and it's at 6,600. So when we put it out, that was about a 9% increase on the year, so a pretty healthy year. But I think the nuances are really important in this situation. And into the year, really focused on what could derail the bull market because we're 2+ years into this bull market. We've actually been overweight stocks in our U.S. asset allocation for over 2 years now. And so it's a question of, what's going to derail this thing. And what we keep coming back to is that the main drivers of the bull market are still in place. Those are disinflation, earnings acceleration, and technicals, which are actually a lot better than maybe what the headlines suggest. As long as those are in place, I think that the path of least resistance is higher for U.S. stocks. Now, I have my concerns as we move throughout the year. We can talk about that in more detail if you want. Now, concerns about each of those really being in place throughout the year. So it could be a situation where overshoot that 6,600 target in the first half, and we come back a little bit later on in the year.
I'm a consumer of your research and I always look at where you're underweight, where you're overweight. And I've noticed that you guys have been overweight US stocks for quite some time. So that's been great information. The last 2 years, 2023 and 2024, returns right under 25%. This year you're expecting returns a little more milder, roughly 8 to 9%, like you said earlier. Now, what could go wrong with that framework, that path?
Yeah. So let me kick off the discussion with that. It has to do with each of those three pillars. So let's talk about disinflation. Look, the market bottom kind of brings down the S&P on end of September, early October 2022. And that was right after that August CPI report came out, like mid-September, where the CPI fell below the 6-month average. Okay, so that's a little bit quantish, conceptual. I think it makes sense that we hit this disinflationary tailwind, and the market just has ridden that tailwind ever since. About a year ago, where we were talking about these hot CPI reports, were become a little bit higher expected, and then the Fed funds futures went from pricing in 6 or 7 rate cuts to 0 rate cuts, and then they went back to like 5 or 6. We ended up doing 100 basis points in the end. But a year ago, there was this fear that inflation wasn't going to come down, and then ultimately it did come down enough for the Fed to cut. But as we get into the second half of the year, it's going to get trickier. So you could take the core CPI and divide into 3 buckets. So you have goods, you have housing, and then you have the rest of services, the so-called super core. Now the super core is being sticky. We don't expect that to come down too much. The housing component, I think, is really interesting. In particular, the multifamily housing part of CPI. Basically apartment complexes. For the most part, there's about a 3-year window from when somebody said, all right, we're going to build an apartment complex before they can actually start renting units. So you have pretty good visibility on the supply coming on. And we're at the tail end of absorbing a lot of those multifamily units that were kind of starting to be built in the early days of the pandemic. Also, you think back 3 years from now, okay, interest rates really started to spike. And that was going to put a clamp on the multifamily housing development. The end result is later this year, that supply is going to come down. Could be that housing CPI starts to move higher. And then the third component are goods. We've actually returned to the pre-pandemic world of in-14 deflation. Depending on if we use core PCE, of course, CPI, it's about -0.5% to -1% year over year for really the last 12 months or so. Oh, man, you throw on these tariffs, then we have a question over whether or not that's going to still be in place. And so you could get some higher goods inflation. You could get higher housing inflation. Overall CPI starts moving back towards 3%. And then if you're the Fed, what do you do in that environment? We think the Fed could cut a couple, maybe three times. Our macro team really thinks three, one the first, each of the first 3 quarters cuts would be in the offing. But then once we get past that, then I think it's a very different ballgame. So the risk would be if that came sooner than what we just talked about. If those really hot CPI reports are creeping in here, saying Q2, the market's going to certainly look forward to that. So that's one of the main things that we'll keep an eye on.
Yeah, and it seems that against that backdrop, that's not really an environment where earnings will weaken or lose momentum. It seems like if inflation risk is to the upside, earnings are going to be quite buoyant, and that's really been the framework of equity markets over time has been the profitability of companies, which remains quite strong.
Yeah, no, it's a really good point. And I think kind of our second pillar. Look, if you go back on the past 6 quarters, we've had this really nice era of earnings acceleration. Now, look, the market likes earnings growth, of course. What the market really likes, though, is earnings acceleration. That is, earnings growth faster than a year ago. And that's really been the story of the past 6 quarters. So most of this bull market, you've seen that. Now, where does that come from? It's come from the Mag 7 primarily. And as we move into 2025, some of those companies are going to be just suffering from the law of large numbers. You're posting triple digit earnings growth quarter after quarter. It's going to be hard to repeat that. Even if they post good numbers, post triple digits 2, 3 years in a row. So what you're going to see probably is a Mag 7 slowdown. I think the Mag 7 in aggregate, last 4 quarters, earnings growth about 54%, expected to slow to around 38. So there's your earnings deceleration. Now the rest of the market, the other 493, they've got -2% roughly the last 4 quarters, expected to get around +6 to +8. So they're going to need to pick up the slack. I kind of question how much that is going to happen. So that's the earnings risk is if, say, the Mag 7 has a slowdown, the rest of the market can't really catch up. But yeah, you brought up a really good point about the economy doing okay. Look, the worst earnings slowdowns and earnings recession, that 20% decline in earnings growth year over year, that comes during a recession because what happens is sales growth turns negative. Too much fixed costs in the systems, the margins gets crunched. So that's not what we're really talking about here. The final point on this is when you think about inflation, if inflation does come back a little bit, can companies pass those costs on? And during the pandemic and immediately after, the answer was yes. And so you look at, say, CPI versus unit labor costs. CPI is above unit labor costs. So that means as a group, companies were able to do that, to pass on the higher costs. We all felt it as consumers, but for profit margins, it was pretty good. May not be that easy this time. Pandemic savings are lower, unemployment a tick higher. And so it may be a situation where the price increases may not be there. So that's another thing we're watching. I think the odds of the earnings story staying around and being pretty constructive throughout 2025 are pretty good, but there certainly is a path there for it to be maybe going from a nice tailwind to a modest hit.
So you mentioned that the companies out of the Mag 7, outside of the Mag 7, are expected to post some earnings growth. Do you think it's because they're more levered to domestic conditions and a lot of the policies coming out of the Trump administration, namely lower taxation, a milder regulatory regime, and the more focus on domestic manufacturing? Do you think that's part of the reason why the S&P 500 minus Mag 7 are going to see some earnings growth momentum?
Yeah. So I think if you were to talk to the bottom up analysts who are crunching the numbers, building the spreadsheets for all these companies, they're probably not factoring in a lot of Trump stimulative measures into their forecast. There's probably a little bit of that. So I'd say that's probably an upside risk is if some of those things come through. I think what a lot of this is that a lot of these companies really haven't had that earnings acceleration over the past year or so. It's really been the Max 7. So they've actually gone through a little bit of, I wouldn't say earnings recession is probably a little bit too strong, but an earning lull. And so they're ready to poised to handle that. Look, the rate cuts are starting to have an effect, particularly if you get out of the mega caps, because the mega caps, they actually benefited from the inverted yield curve because they issued a bunch of long-term debt a few years ago when rates were low, and they generate a lot of cash flow. And so they actually earned more on their cash that they were paying out to bondholders. But the rest of the market didn't have that advantage. So actually the interest rate regime is a little bit more favorable for them. So I think here's an interesting stat. So for the S&P 500, we're still fairly early earnings season. About 40% of S&P 500 companies are reported, but the beat rate, percent of companies exceeded expectations, that's actually gone up. We're about 78, 79%. And it was the low to mid 70s last couple quarters, so a little bit better. But amongst the S&P small cap 600 index, there's only about 30% reported so far. So a long way to go. But the beat rate's lower because smaller companies generally, they can't manage their earnings quite as well. But their beat rate, 69% at least so far. That would be the highest in over 2 years. So you're starting to see this the biggest companies, things are starting to come through. And so that's another theme we can talk about if you want, about potential rotation, some opportunities outside of the Mag 7. But that's our thought on the macro environment and how it affects your earnings outside of Mag 7.
Ed, how come the Treasury didn't issue a bunch of debt back in 2020 or 2021 when rates were 0?
It's funny stuff you think about. And I know you're probably the same way. You're driving your car and you're thinking stuff like, "Man, why would he just issue a 50-year bond? If Argentina can do a 100-year bond, surely the U.S. Treasury could pull it off." I think it was Stan Druckenmiller, I believe it was. He's the one who proposed that too. I also read something pretty interesting about that. And the Treasury is looking at where the demand is. And if you look at the buyers of bonds, I think it would happen to be more on the shorter end of the curve. That was what it was. But yeah, wouldn't it be a cool idea to just take a few trillion and throw it at long-term bonds? There'd be buyers of it. Now, my fear for that, what do you think Congress would do with that information? Oh, okay. We don't have to worry about that debt anymore. Let's just spend some more. I don't know if it really fix the problem. I just have a lot of faith in Congress's ability to handle something like that maturely.
So, Ed, before I ask you about why slow rate cuts are bullish for stocks and an extended pause is not, I wanted to let you know that in August, myself and Steve Sosnick, we hosted a podcast here at Interactive Brokers with Steve Moran, who's now the chief economist of the Council of Economic Advisors, and Nouriel Roubini, Dr. Doom. And they argued pretty strongly, I would add, that the Treasury didn't have any buyers at low yields out there on the curve, 5 years, 10 years, 20, 30 years. So they didn't diversify their maturity structure and they just issued at the short end to keep markets calm. I think that was also a pretty strong that dampened volatility and really allowed, markets especially in 2024. I didn't think after such a strong year in 2023 we'd have another one in 2024. I was expecting 2024 to be sort of what your outlook is this year, 10% or so. But turning back to the topic, why is a slow pace of rate cuts bullish for stocks, but an extended pause is not?
Yeah. First, let's just talk about the data. Once the Fed starts to cut rates, the market tends to respond positively. The old Wall Street cliche, 3 steps and a stumble. So 3 rate hikes, the market goes down, and two tumbles and a jump. So 2 rate cuts, and the market gets going. That pretty much holds. But not all easing cycles are created equal. So we divided them, going back to World War II, into slow and fast cycles. There's been about 16 of them. So a slow cycle means we're averaging 4 or fewer cuts a year. Fast cycles, 5 or more. And the markets are much worse under the fast cycles and the slow cycles. You think at first, it doesn't make sense. If that's cutting quickly, shouldn't that be better for stocks? And then you start thinking, why are they paying? And for that, it's because they've already messed up. They're already behind the curve, and now they're just pushing on a string. So the last few fast easing cycles, 2019, first when you get the pandemic, 2007, financial crisis, 2001, you get into the dot-com bubble bursting. Sorry, guys, a little bit too late. Contrast that with the slow cycles. Again, 4 or fewer in a year. You're talking about 1998, 1995, which is like the gold standard of all easing cycles. 1984 was another one where the Fed can cut. Keep an eye on things. Oh, okay, inflation's still coming down. Economy's doing okay. Let's cut a little bit more, etc. Stocks love that up about 24% in the first year of those slow easing cycles. And so that's the rationale behind it. And I'll give you like, and I think we talked about 95, it's a great example. 84 is one that I have my eye on. I really don't think we're going to replicate that, but it's an interesting benchmark. Okay. So inflation peaked 2 years prior, major peak, how it happened last year. Um, Inflation came down early in 1984. Inflation moved higher like early 2024. Then it started to roll over. There was an election coming. Now that time in 84, they actually waited until after the election to cut. It was November 21st, 84, first cut. But then from there, the Fed cut rates 7 times by 50 basis points every time for over a 2 year period. Now, they're short at 9%, so they had more room to go. But inflation just kept coming down. Oil prices collapsed in 86. That was very helpful. There's a glide path if inflation keeps coming down for this to go on for a while. Again, I don't think that's the case. I think we're going to get most of the benefits, the first half of this year, and then things get a little bit tougher. But that's really what the message of a slow easing cycle is. It's like the Goldilocks, rates coming down, but still positive growth.
I'm glad you bring up that time, Ed, because whenever folks think about monetary policy officials taking on inflation and price pressures being reignited, they always mention Arthur Burns in the 70s. But in the 80s, Volcker had to deal with that as well. He cut a little too early and then inflation came back and then he had to raise again. So I'm glad that you brought that up. That's an interesting one for the economic historians out there. Now, Ed, I learned how to invest at a very young age, but I learned value investing, a style that hasn't been that profitable in the last 20 years or so. So I'd like to, my final topic and question while we have you here today, we're very grateful, Ed, for your presence, is how do you feel about the valuations of this market, Mag 7 concentration, and lastly, compare that to the dot com and Nifty 50 eras?
Yeah. Yes. Let's start off with Mag 7. What are we talking about? Sorry, I'm growth versus value. Excuse me. Mag 7 in a second. So, way back when Fama and French, for those of you who took finance at school or have an MBA, they really jammed this three-factor model at us, which makes sense. It's a good framework. But the book to price became the value universe. And what they found is that if you buy low valuation stocks, they tend to outperform over the long run. Makes sense. But when they were doing their study, they were looking at a totally different era when the US economy was very manufacturing. So you got these frequent recessions. The inventories would build up, and the Fed tightens a little bit, inventories have to come back down, you go into recession. But then once the inventories were spent down, you have to start making stuff again. And so you come out of it pretty quickly and pretty strongly. And so if you bought a cheap stock, a value stock, you didn't have to wait that long to be rewarded for it. Then by the time we got into the 90s, the US economy transitioned to be more consumer oriented. Consumer spending is more stable than manufacturing. So good news, longer think. Bad news, get this massive debt built up throughout this expansion. And so once you finally get the recession, the hangover is so much worse because even though the economy is technically expanding, you always say, oh, this is the start of the expansion. Didn't feel like it. Get these so-called jobless recoveries, things like that. Potential GDP is less. And so you get these periods of low but positive economic growth. That's great for growth stock. Because, as an investor, you're going to think, okay, growth's slow. I'm going to pile into those few companies that are going to give me the growth. By definition, those are growth stocks. And so you see these windows go wider and wider since the 90s of growth beating value. Then we get to the pandemic. We're all stuck at home watching Netflix on our iPads. That's probably peak growth investing right there. And so as the economy reopened, we got this value rotation for a couple of years. And then we came out of that 2022 bear market and AI took over. And with that, we got growth resurging. But it really was just a small group of stocks. If you were to look at, say, the Russell 2000 growth versus 2000 value since 2022, hasn't really come back much. In fact, Russell 2000 is still like 25, 30% below where it was in 2020 relative to the 2000 value index. Whereas the Russell 1000 growth is at a new cycle high versus value. So this really has become a bifurcated growth market, which isn't really a great leg to stand on. And so that's how you get things like Mag 7 dominating the indices. The top 10 stocks in the S&P 500 are 39% of the index. The dot-com bubble, they only got it to 30. Nifty 50 era in the early 70s. Remember, that was just buy good companies, don't remember the valuation. Well, then only got to around 34%, well above that. So this is really a record concentrated era. And the difference between now and say .com is that these companies are fabulously profitable. They generate huge cash flow. So it's not like, you know, pets.com or whatever, some guy delivering groceries on your bike, on his bike, or the stuff they had back then. These are real companies, but nevertheless, trees don't go to the sky. Creative destruction is a real thing. Eventually, their moats will be broken and they're going to have trouble, and the market's going to be pretty concentrated. And so that's the risks that we see. Is it imminent? Maybe not. I'm not sure it's going to happen right away. The DeepSeek news of a couple of weeks ago, I think that the nice reminder that this may not play out exactly as these companies, hope. And if something comes along, then we'll have to question the really high multiples that these Mag 7 stocks are trading at. And so you could get a rotation. As we alluded to earlier, there has been some nascent signs of that. The equal-weighted S&P 500 has been in a trading range versus the cap weight for the last 6 months or so. So it's not like the Mag 7 has still been outperforming as dramatically as they have before. We also talked about the earnings growth, maybe coming back from other parts of the market. Final stat I'll give you is I don't think this is .com 2.0. Just to be clear, again, those companies back then, a lot of them didn't really have real business models. But from the March 2000 high to the October 02 low, the S&P was down like 55-ish%. The Russell 2000 value down 5. And it was above water most of the time. The last kind of couple months there, summer to fall of 02 is when it was underwater. So there will be opportunities when this happens. And it's going to happen at some point. It's always a bull market somewhere. So I don't want to sound too doom and gloom to say Mag 7 is dead, but we just know at some point there's going to be a very meaningful rotation. They're big stocks to affect the cap weighted indices, but there'll be other opportunities to find some good winners.
All right, ladies and gentlemen, that's Ed Clissold of Ned Davis Research. Thanks so much, Ed, for joining us.
Thanks for having me.
Folks, press like, press subscribe. Don't forget to review Interactive Brokers podcast. Thanks so much for joining us, and I look forward to the next one. Bye.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.